everyone. Thanks for joining Jeff and I today. The heat wave is over for a few days anyway. Hey, back to normal.
Yep. Let's hope it doesn't return its ugly head because I've had enough.
Yeah. Well, I think they're expecting highs again into the 30s next week sometime. So we shall see.
Yep.
Today we're going to talk about United Health Group. Back in, I guess, last year, they had an incredible dip in the stock price that occurred from a few things. I guess healthcare utilization, where they had a bit of a panic because there was an oversurge in specific areas of the medical field. Um, so we ended up looking at it as a purchase back in May 20th, 2025. And let's go through some of the reasons of why we did that.
Well, sure. The reason the stock had dropped so much was because there was this surge of elective procedures being done. Those are things like hip and knee replacements. And the company had not expected that utilization rate to be so high. And so for that reason, their costs were significantly elevated, and therefore they wouldn't earn the same amount of profit last year that Wall Street had expected. So when they came out with this incredibly poor quarter, the earnings target for last year was slashed by about 40 percentage points, which is a very, very, very large reduction for what is really a blue chip company. I mean, United
Mhm.
Healthcare has had years of strong performance, so it really caught the street off guard.
Yeah. They also had some management changeover as well. So Andrew Whitty was in place, and I guess he stepped down, and then the former CEO, Stephen, what is it, Hemley, stepped up. And at the time, he ended up making a huge purchase of shares of what, 25 million? Plus
Yeah,
other directors as well were making purchases when the price pulled back.
yeah, including the CFO who bought $5 million. So when we heard about these large private purchases, we started to look at the stock to maybe buy it for our clients. So we did our due diligence, and anytime we have an investment idea, we always summarize it down to a couple bullets. Why do we own the stock? And then each time there's a quarterly earnings call, we review that same research to see if our thesis has changed. And
Yeah.
so at the time, we bought the stock in May of 2025. It was on May the 20th. And we wrote down three reasons why we were going to buy it. Reason number one was the stock's down 30% 1 month. Reason number two was that its valuation hadn't been this low since 2013. And then the third reason was that $25 million purchase by the new CEO, who had, as you say, been the former CEO from 2006 to 17. So he knew the company very well. And he was
Mhm.
also the chair. So, I mean, if he's going to put his own money behind it, I'm prepared to do the same.
Not to mention, Jeff, that Warren Buffett, Berkshire Hathaway purchased a huge position and they announced it, I guess, at 1.57 billion.
Yeah. Yeah, they announced they made that announcement in August sometime that they had purchased it in the second quarter of 2025. We had already bought it at that point for our clients, but it was reassuring to know that we were looking at the same ideas as Warren Buffett. So everything seemed like a bit of a mess, but we knew that mis they had just underestimated the expenses for last year. And we knew that they would be repricing their policies as the calendar turned into 2026. So this was a classic contrarian idea where we always look for the same thing, a stock that's dropped a lot and it's over a temporary, non-recurring problem. So we bought it across the board for clients where it was suitable. And
Mhm.
we bought the Canadian depository receipt. And that simply means that we're buying a US stock, but we're hedging out the currency. So if the loonie goes up, It doesn't affect the client's holdings. The CDR moves by the same percentage as the US stock. But on the day we purchased it, May the 20th, stock ranged between 312 and 321 on that particular day.
Hmm. And currently it's back up to over 430.
Yeah. So it's been a great return, and we've only owned it for what, 14 months?
Yeah.
They just came out with earnings last week and they were really good. The earnings per share were up about 56% year over year. Their medical cost ratio, so that is the expenses paid out in claims divided by their revenue, dropped from 89.4% last year to 86.7. So you want a low number. So that was a pretty big drop. They also raised their guidance, and we're expecting to see double-digit earnings growth this year, next year, and the one after that. So it's still trading at a good valuation considering its high growth rate. And this has been a great stock for clients. I'm so happy we bought it, and we'll continue adding it to new client accounts.
Yeah. Okay. Great. Talk to you soon.
All right, thanks.